Good evening, everybody. Happy Thursday. Almost the end of the week. Only 10 shopping days left until Christmas. I hope you're ready. We're going to give it just a minute or two, like always. In the meantime, you should see my screen. All about tonight's Options Foundations session on spread trading. Seeing here, okay, good. Thank you, Stephen. Thank you, Bob. Hi, Perry. Good to see you. Good evening, Bob. Good evening to you, Stephen. Good evening, everyone. Well, it's cold where I am. Probably where you are too. 32. Oh, we're 30. We're the exact same, Bob. Exactly the same in Utah. Okay, let's get into it. Welcome to the Market Watch Group Options Foundations course. Tonight we are discussing having a discussion discussing spread trading combinations. Now we talked about the basics of options. We talked about buying options. Tuesday we talked about selling options. So we've done buying calls and puts. Actually placed a trade from what we found and did well with it. We have we did calls and puts. And then we did on Tuesday selling options, which has created for us our building blocks. Buying calls or puts, block. Selling calls or puts, block. Put them together. What do we have? A combination, which results in a spread trade. And that's what we're talking about today. When I buy one and sell one, I've got two things working almost contrary to each other, but ultimately working in collaboration, even though one goes one way and one goes the other for both price or for all three: price, time, and volatility. Bob says, please discuss where you would use spreads versus straight call or put. Of course, we are deliberate in everything we do. Deliberate, meaning on purpose, well planned, and thought out, rehearsed. It's on purpose. Took me years to reframe my perception and understanding of the word deliberate, because as a kid, it was a bad word. You did that deliberately, usually referring to me hitting my brother. And the accusation was usually true. I did do it deliberately. I did think about it and visualize it in my head. Thought, it would be great for me to hit him right now. And then I did it. Okay. Deliberate now is everything we do in trading. So let's dive in. I'm Scott. I'm your host. These are our disclaimers, as always. And this is today's agenda. So first and foremost, I just want to give a little bit of a formal introduction to spreads. What are option spreads? Spread is interesting because it's used a lot of different ways. Um, you know, spreads are used to describe the difference between bid and ask, and is used as a liquidity measure within the context of spreads. There are spread trading that we're talking about now. So there's a lot of different ways where someone spread something, spread even spreads across bonds they have, right? Where you spread it across multiple classes and expirations. A lot of different ways. What we're talking about is equity option spread trading combinations, and we'll go through exactly what that means. We're going to talk about the advantages trading spreads gives us. We're going to talk about the potential risks of spreads that we have to prepare to avoid, mitigate, or overcome. Then we're going to specify. Initially here, we're going to cover credit spreads today. Then we're going to do debit spreads on Tuesday. And then what do we do from there? Sorry, I need to pull up my agenda. I completely forgot what the 6th. So let's see. Bear with me. Then on 7th session, we are going to go into advanced combination strategies. Oh, no, sorry. Next Thursday will be time spreads, calendars, and butterflies. And then we will do advanced combination strategies, which will be iron condors. Actually, it'll be calendar and diagonal next time, and then we'll do iron condors and butterflies as advanced combinations. And then we'll talk about implied volatility on the Greeks to wrap it up. Lot still ahead of us. Will we have a different host before the end of the year? I gotta check in with Gary. I will. You guys are gonna laugh, but I walked him through, everything we do. And, he's like, Scott, that's a lot. We do a lot, right? I mean, we do. We've got a lot of stuff. We've got our trading plan. We've got our record keeping. We've got our market forecasts, our market posture spreadsheet. We've got trading foundations. We've got options foundations. We've got a lot. He's like, he was a little overwhelmed. And I'm thinking, God, look at all you surviving that. And you're coming in, learning it. So it made me laugh. But yes, I'm hoping to get him ready because he's a great resource. He's a great trader. Once he has a good sense of what we do, he'll adapt very well with us, be a great contribution, a great contributor to the group. Okay, we're going to talk about the specificity of credit spreads. Two different types. We're going to start with bull put. Obviously, that's what's way more important to us right now. Though, interestingly, as Bob asks about what would it be that causes us to go with credit spreads over buying calls, and typically the answer is going to be implied volatility. The higher the implied volatility, the more likely we're going to take a directional trade using a spread rather than buying the option. Ergo, unlikely to do it now. There's not much premium to sell. We're selling premium. If options are cheap, you're selling cheap options. Yeah, doesn't sound all that appealing, right? So Bob agrees that we have an overwhelming amount of information. We do a lot. Lastly, we're going to talk about the considerations for credit spread trading. Summarize it. Okay, let's dive in. So, and I'm going to pop out, and I'm going to get into the platform a little bit as well. I didn't mark it because it's like I don't really need to. We're just going to jump out, build a spread, look at a risk profile, let you see how we go about doing it, and we'll go from there. So what are we talking about with option spreads? Again, when we talk about option spreads, a lot of times people just are like, oh, I'm a spread trader. And in their mind, they mean they like debit spreads or they like credit spreads. We've got to step back and define it a little more broadly in order to then get a little more specific. Broadly, when we talk about spread trading, what are we talking about? A combination. That's why a lot of people don't call it combinations anymore, but that's exactly what it is. A combination of buying and selling two or more options of the same underlying stock, aiming to profit from relative movement between their prices, but not necessarily the absolute direction of the stock itself. What does that mean? It means that, yes, we do bullish spreads, but we're not just making money from the movement of the prices, but we're also making money potentially from time decay. The fact that one option expires at a faster rate than the other, and that means that net result, we are positive time decay. We might be profiting from a decline in implied volatility. One option will decline at a faster rate than the other based on implied volatility dropping. Well, this is a credit spread. So you might be thinking, Scott, what, I want the price to decline? Yes. Yes. We absolutely want the price to decline because we're a seller. If I sell a stock short, I'm selling it at 50 and I want it to do what? Drop so I can buy it back cheaper. Stock doesn't expire worthless. Stock is stock. It has value as long as the company has value. Options have an expiration. So when we sell options and they get to expiration, if they're still out of the money, they expire worthless. So whatever I collected for selling it, I keep all of it if it expires worthless. If it's not going to expire worthless, what would my objective be? To put myself in a position to buy it back cheaper. If I sell an option for $2 and I can buy it back for 50 cents, well, that's pretty good. It's no different than if I bought it for 50 cents and sold it for $2. I make the same $1.50 times however many contracts, right? That's the same thing. So what do I want if I'm a seller? And that's what we're doing with credit spreads, not necessarily all spreads, but with credit spreads, we're selling it. So what's our benefit here? Reduced directional risk compared to single option positions. Buy an option, goes up, you make money. If it doesn't, you start losing because you're losing from time. So it's not just directional risk with single options. It's also time risk. If I buy an option and nothing happens, I'm losing money at a fast rate. If I do a spread and nothing happens, either I'm losing money at a much slower rate or I'm potentially gaining money. That's one of the core advantages, or at least core potential advantages that spread trades give is similar to a naked put, and that is time decay. I am positive time decay. The longer I'm in the trade, the more money I make. That's huge for us, right? Because when you think about the three core variables that exist in options trading and analysis, we have price, we have time, and we have volatility. Price goes up and down by the trend and by other factors. Volatility goes up and down based on supply and demand and emotions and other factors. Time always ticks. Always ticks. At what rate? Exactly the same rate. 24 hours a day, 7 days a week. That's how it works. So it is the most consistent variable that exists in options. Right now, with options cheap the way they are, we are definitely looking to buy them more. Right? So you're like, oh, so you're buying something that's going to lose money in time. Yes. Eyes wide open. Eyes wide open. Yes, I am, but I'm not paying very much for it because I know that if I have some 2.5 or 3 to 1 reward to risk ratios on stocks with cheap options, I can turn that into 4 to 1, right? 4 to 1. I can't do that with options or selling an option. When I sell an option, I am limited to the premium I collected. Bob just said, I sold one for 30, bought it back for a nickel today. Doesn't make a lot, but it adds up. Get you on base, right? You get on base, you're ready to advance and move into scoring position. The more we get on base, the more we can score. That's right. That's a lot of times what we're doing with options selling. When we buy options, we can hit home runs, but how often do you really hit home runs? For any old baseball fans out there, we want to be the Cal Ripken. If anyone remembers him, the Cal Ripken guy never missed a game. Was he known for home run hitting? Nah. Did he get on base a lot? A lot of RBIs. Did everything right most of the time. That's what we want to do. We're not here to be flashy. We're not here to break any home run records. We're here to get on base, advance the runners, get them into scoring position, and then score over and over again. Consistency. That's what we're trying to do. And that's what it gives us the ability to do. We aren't just faced with direction. We're also able to put into play time so that if the stock doesn't move, I might still make money or I might not lose money, which is fine too, right? We can also capitalize from volatility. So we're capturing the dance of options, price, time, volatility, all moving interchangeably rather than betting on a single outcome. Stock goes up, me make money, right? What's an example? I buy a near-term call, and then I sell a further out of the money call on the same stock. So what happens is the price that I collected for selling the out of the money option pays down the cost that I paid for buying the option. So now my max loss is less, right? Now, unless the stock goes on a home run, right? I have a higher probability of making money. I lose less money from time decay. Essentially, you're saying, you know what? I know I'm not going to hit a bunch of home runs. Knowing that allows me to sacrifice the home run in order to make more money when I'm getting on base, make more money more frequently. That's the objective here. Love it. Bob said, paid this month's tuition, that one trade. Love it. All right, let's explore spread trading. There's a lot of different spreads. Initially, right now, we're going to focus on directional spreads, so bullish spreads. Directional spreads bearishly. We're not bearish, but I would rather you understand bear spreads before you need them. Before you need them. If you wait until you need it and then you try to understand it, you're going to be behind the 8 ball. But a bullish spread, we're going to capitalize on bullish expectations. This is one way. Buy closer to the money option, sell further out of the money option. That's a bull call spread. Sell a put at or slightly out of the money. Buy another put just below that. What do we expect it to do? Stay above both of them. And if it does, we make money. How? They both expire worthless. We collect a credit on day one. And if the option does what we expect, which in this case is just don't go down. That's all I need. Doesn't have to go up. Doesn't even have to go that sideways. It just has to not go down very much. And if that happens, which is a higher probability equation, I make money. Now, am I going to get the same reward to risk ratio? 4-to-1? 3-to-1? No. You're sacrificing reward to risk ratio in order to do what? Raise your probability of success. If I was only right 40 to 50% of the time buying options, but getting 2-to-1, 3-to-1, now I might be getting 50 or 60% winners, but I'm only going to get 1.5 or 2-to-1. I'm not getting 3-to-1 or 4-to-1. Not with a spread, right? That's the objective. Calendar spreads, time decay is your ally. Right? We buy near term, we sell further out of the term, we benefit as time premiums expire, or vice versa. We can do them either way. So we're going to talk about all of these spreads in more detail. That's just kind of scratching the surface. What are your advantages? Reduced directionality. So we have some flexibility. We don't have to just like, it goes up, I make money, it goes down, I lose money. It's a very binary event. That's not what it is. Now we're adding the element and dimension of time and the element and dimension of implied volatility, so that if we miss price but we get the other two, we'll probably still be okay. That's the benefit. Capital efficiency. Spreads. If I said I'm going to buy stocks at, let's say the stock's at 52. And I'm going to buy a call. I'm going to buy a call for $50. It's going to cost me $350. Right? That's my risk, $350. I can lose $350. Now, if the stock goes up to 100 or to 90, I'm going to do great. If the stock goes up to 55, I'll do okay. Maybe I think the stock's going to get up to 56. Well, if I think it's only getting to 55 or 56, I can sell a $55 call. So now let's say that I collect $1.50 in premium. I sell for $350, collect for $150. What do I get? $2. Is $2 less than $350? Sure is. That's the most I can lose now. So I've reduced my risk. Am I going to lose as much in time value? Nope. Am I going to lose from implied volatility? Nope, because I've balanced those two trades. Now, have I capped it? I have. I'm capped at theoretically 55, but actually that's at expiration. I'll probably make money up to 56, 57, right? And that's what I'm hoping for. And so what I'm doing is I'm sacrificing max gain in order to improve the probability of success. I'm more likely to make money because I've made it easier to make money. That's what we're doing here. That's why. Some people don't really understand the why of spread trading. It's important that you do. Volatility plays. We can profit from increasing or decreasing volatility. So if all volatility is very, very low, like it is now, could we trade for volatility to rise? Sure, we could. Absolutely. Defined risk and reward. We have predefined profit and loss potentials. So it makes it easier for us to manage our risk. All right. Let me know if you have any questions. We're going to go through a little bit more of the generics, and then we're going to hit the specifics. And we're going to talk about bull put spreads, and then we'll talk about bear call spreads, and then we'll go from there. The potential risks of spreads. Correlation risk. We rely on expected value, expected relative movement of options. Unexpected correlations between underlying stocks or option prices can affect profitability. So if all of a sudden, things don't move the way they're expected, then there could be a problem. So yeah, can that happen? Sure. For long periods of time? No, that's really something that happens in the short term, and we tend to see it correct itself, but it could be stressful in the meantime. Liquidity risk. We talk a lot about this, right? Whatever I need for singles, I need more for combinations. If there's a time where you're like, hey, you know what? I don't have great liquidity, but I still want to make this trade because I'm feeling really good about the movement. You might say to yourself, I'm going to take the trade even though the spread between bid and ask isn't great. I'm going to do it anyways. Now, I'm not going to take outrageously bad spreads. I think that's just bad trading. But if there's something that's on the bubble, I might do it. Because I can maybe get the market maker to split the difference with me and get in between the bid and the ask. If I'm doing 2 contracts and I'm facing illiquidity, the odds of me getting that same advantage are decreased significantly. And in fact, what happens is you may find yourself in the opposite situation where you can't get filled at a certain price because of the spread, and you have to widen it in order to take the loss, and it ends up getting worse and worse and worse. It creates a lot of slippage. So whatever the risk of slippage is with a single, it magnifies when you start doing combinations. The more option contracts involved, the more liquidity is an absolute necessity. Another risk that we want to try to understand better is the Greeks. Understanding the Greeks is very important to help us manage spreads and understand the risk profile. Delta, what is it? If the stock goes up or down, what happens? Theta, what is it? As time decays, how does it impact me? Vega, what is it? As implied volatility goes up or down, how does it impact me? So I have 3 variables. 2 of them are always, or 2 of them are going to fluctuate directionally up and down. One of them always goes the same direction. So that helps a little bit with time, but those are the things that we're facing. Lastly, the risk of potential risk of spreads is the requirement for more active management. We got to keep our eye on it. We can't just slap a spread on, walk away, come back in a week and be like, okay, how'd we do? Probably not how you want it. So we require ongoing monitoring because we may potentially adjust a spread, right? We might. So yeah, that's important for us. Okay. Let's get into specifically credit spreads. What is a credit spread? We start as a seller. That's the most important thing. We start as a seller. So a credit spread involves selling an option first, then buying another option with the same expiration date aiming to profit from the difference in premium. Well, yes, we aim to profit from the difference in premium, but we aim to profit on it as price goes the right way, as volatility goes the right, which is up if it's a bull put spread. Volatility goes the right way, which is down. Do we expect volatility to go down as prices go up? Yes. Do we expect it when the volatility is already low? Yeah, maybe not as much. And we expect to profit from the differences in time. Bob asked the question, said, can we use stops on spreads? We can, but just like we have to be more careful with slippage on spreads versus singles, we have to be more careful with stops and conditional stops, because bad slippage gets to worse slippage when you're dealing with 2 contracts, or with butterflies 3 contracts, or with iron condors 4 contracts. I will use them. Oh, absolutely. What I'm telling you is, whatever my restrictions are, you guys know I'm pretty restrictive, right? I've said there's maybe only 300 or 400 stocks I would be willing to trade. Probably only 50 to 70 that I would do spreads on. Buying options, yeah, I have a little wiggle room. Once I add another contract, I lose that wiggle room. So really be liquidity snobs in that regard. Same expiration date, different strike prices. A credit spread is same expiration date, or excuse me, same strike prices, different expiration date. A diagonal spread, different expiration dates and different strike prices. A lot of different ways to combine. In fact, let me just pause for a second. Let's dive into the platform for a minute. Yeah. Oh, I'm gonna have to hurry, and I thought I had my paper account up to use for examples. Let me just bring it up here. That is a counter spread, isn't it? When expirations are different? Yes. Or a diagonal. A calendar will have different expirations. A diagonal will have different expirations. Most other spreads are going to have same. So if you're dealing with vertical spreads, which is what we're doing here, vertical means bull call, bull put, bear call, bear put, credit and debit. That's what makes things hard sometimes, is there's a lot of different ways that people will talk about it. And so it's just, the more we do it, the better off we're going to be. Oh, that's not what I meant to do. Hold on a second here. Paper money. Okay. Now, let me get this up. I like that you guys ask questions along the way. So let's go in. Oh, that's an amazing question, Bob. This is a controversial one. He said, how do you decide to do credit versus debit? And oh, you're gonna hear some answers out there, and I'm gonna be the lone voice of reason, okay? Um, it's a personal preference. And you're gonna hear people say, oh, when volatility's high, you want to be a seller, so you do a credit spread. And when volatility's low, you want to be a buyer, so you do a debit. That's false. You're a seller and a buyer in both of them. Now, here's what I'm gonna tell you. Whatever credit spread somebody builds you, I can build a debit spread that looks exactly like it. And when I say it looks exactly like it, I mean by risk profile. I mean by the Greeks that tell me how does it behave if stock prices move, if option prices, right, etc. If that makes sense. So. Sorry, I was just distracted by something here. Now, Let's get into that. So I'm going to show you a risk profile. I wanted to use a live example. Let me just see if I can't wrangle up a signal real quick. So I talked to the to my partners in this project, and we're thinking about adding alerts to the service. What do you guys think about that? Would that be helpful? Steven said yes. Love it. Yeah, it's gonna be an alert channel on Discord. So if you're not on it, you better get on it. Because it's gonna be, I think everyone here is, but that's we're looking to release that. So basically every Sunday we'll create a basket of setups. And from that basket, we'll look to, I'm going to put out an alert that says, okay, XYZ, ready to go. Bing. Here's the stock parameters. Here's the option I'm thinking about. I'm only going to do buys. I'm not going to do spreads. That's going to really work the complexity unless we get, but if we get to a point where we are at a high volatility, can we do Discord on our phones? Absolutely, yes. Then I will do credit spreads at that time. So let's go through this. Did you guys see Adobe on earnings? That's why we avoid earnings. Oh, look at that. That was nasty. Aflac was nasty today. Did anyone stop out of that? I went with AIG and I ended up just shutting down because I saw Aflac and then I'm like, what's going on? And I got out and took some profits, but man, that was nasty, nasty. That shows you why we need alerts, why we need to be, don't rely on watching the charts. If you're in a trade, set an alert. You probably have, if you're like me, you have your phone with you, set an alert that dings you. That's like, whoa, something just happened. That's what happened to me. My alert went off. I'm like, oh shit. Amazon, no. A lot of things. Oh, who's in AXP with me? What? Looking good. Who's in BX with me? Bam, bam, 2 days. That's a left-right combination right there. Beautiful. Beautiful. Costco coming back down. Oh, let's see how the earnings did. Press said he felt stupid confident about earnings, but I recommended, if it was me, I'd shut it down at 640 or right the day before, and it's actually up, but it's only up back to 639, so that's interesting. All right, we're getting a little distracted. I've got to get these going. Let's get in. I feel like I'm in a session, but I've got to get to the spread, so let me just find one. God, it's been a fun week though, right? Google's close. Damn, look at Home Depot. IBM, I got out of my IBM. I only got 2 days out of it. That could be setting up again though. Whoa, Intel looked like magic today, and then it gave most of it back. I already took my first piece back here, took another piece here, only in the third. Oh, that was frustrating. Holy shit, it was looking good. I'm sorry I'm cursing so much tonight. It's nighttime. Come on, there's got to be one. Everything is so overextended right now. Microsoft shut down. PLTR. You know what? I'm not really bullish on it, but I'm going to use PLTR because at least it's bouncing off of support. I don't like that it's, pulled back the way that it has, but this one will do. So I'm going to just build a quick credit spread. I'm going to sell 18 at or slightly out of the money put. Out of the money is slightly below, so I'm going to do 18. I'm going to buy further below, which is going to be 16. Oh, beautiful. Bob took some profits from his ICE trade. Love it, man. We were bullish on financials here. We were bullish on financials and industrials here. I can tell you that. Okay, let's do it. Let's go into PLTR. The implied volatility was decent. I did like that. Let's go out. Let's just go out here. Now, a couple of things. This is what I wanted to get to. Okay. First things first. Let me get my drawing tools. First thing, where's my meeting? There it is. Draw. Green is good. Spread. Single. No. I want to go vertical. So credit and debit are two subcategories of vertical spreads. Credit spreads and debit spreads. You'll hear people say vertical. You'll hear them say credit and debit. You'll hear them say bull call, bull put, like, which is the specific type. They're all interchangeable. We're going to use vertical. You'll notice now in my strike prices, I now have these. They're only one width apart though. That doesn't mean that's what you have to do. I actually tend to go sometimes 2 or 3. I will move that, but it starts this way. Okay. Now we are starting with credit. Credit means sell. What column represents selling? Bid. Right? You buy the ask, you sell the bid. So if I'm working on debit spreads, I'm going to change my color to red. Debit spreads are over here. This is a bull call spread. This is a bear put spread. Those are debits. We're not working with debit. We're working with credit. I'm selling something. Okay. What am I selling? I'm selling now this is calls. This would be a bear call spread on the left. This is a bull put spread. Your credit spreads are bear call and bull put. How do you remember that? You don't. You memorize it. You wrap your mind around it. You say it over and over again. I literally almost got hit by a car in downtown Salt Lake City, walking to lunch from the Fidelity building back in, I don't even know what year it was, 99 maybe? Because I was wrapping my mind around bull call versus bull put, bear call versus bear put. What is credit? What is debit? You just got to memorize it. Flashcards, whatever you got to do. We all have to go through that. I wish there was an easier way. Bob said, say it again, please. Your credits. That's what we're working on today. That's the only one I'm going to say today, because you can go back and watch the recording, and next time we're going to do debit. Credit spreads are bear call. These are your calls over here. So this is your bear call. And your bull put credit spread. That's over here on the right. So now, let me show you real quickly. Thinkorswim is going to be a great tool here. It's going to be a great tool here. If I click, I said I'm going to sell the 18. So let's go right here. If I click this, you'll notice I have a credit of 40. If I click this one, I have a debit. Credit on the left, right? So if I click here, that is a credit. It's pink. If I click here, that is a debit. It's green. Same thing on the other side. So we're working with a credit. I said I might just go ahead and go 2 strikes wide, and I get a credit of 67 cents. Let's do a quick risk profile on this. Then I'm going to go back into my slides. I just need more time when we do these. I wish I had 3 times as much time to go through this. I just don't. It's all right. I'm going to get through it. I can manage. Here's my risk profile. Now, when we looked at a risk profile for a stock, it looked like this. It goes up forever and it goes down to 0. Remember what I told you are the characteristics of spreads: defined risk, defined reward. Yeah, that's my defined risk. I cannot lose more than this amount. In this case, it's about, I don't know, 1,300 if I eyeball it. What's my defined reward? It's up here on this side. I can make about $600. Wait, Scott, you're saying I'm risking $1,300 to make $600? If I'm going off of max loss and max gain, yes, but I'm not doing that necessarily. In fact, I would probably look at this point right here around 17 and say, I'm gone if it drops below 17. The stock's at $18.18. That's $1.20 away. That's a pretty big drop, right? Let's pull up the chart again real fast to make sure this is clicking. Remember that these are recorded. You're going to want to go through them again. So I'm wrong down here. If it gets to, let's say, 1690, you'll notice it's below this low and this one, both of these, 1690. That's where I'm wrong. I'm wrong if it breaks below all this price. Great. 1690 is right in this area here. And in this area here, I'm only risking about $300. $300. What's my risk or what's my reward? My reward is up here around 670. Let's say I'm not going to get all of that. Let's say I'm only going to get 80, 85% of maximum, right? Something along those lines. 80 to, now I'm not getting 660. I'm only getting maybe like 550, right? About 20% of it. Well, if I'm risking 320 to make 550, I'm not getting 2 to 1. I'm getting about 1.8 to 1. But remember, what does this have to do for me to make money? All it has to do is stay above 18. Where is it now? 18.18. So that means if it goes up, I make 2 to 1, 1.8 to 1. If it goes slightly up, I make 1.8 to 1. If it goes sideways, I can make 1.8 to 1. In fact, it could go down. My break even is at 17.30. It could drop 50 cents. I still make money. So what have I done? I've added a significantly higher probability factor. Yes, significantly higher probability factor. So if I go into a probability analysis and I say, what are the odds, right, that it stays above 17 and a half over the next couple of weeks? The odds it stays above that is about 70 to 80%. There's a 70 to 80% chance it stays above that level. So my probability is pretty good. Now, like I said, is it a home run? Nope. But is it easier? Is it easier to be successful than it was with our other trades? Absolutely yes. Okay. I'm gonna switch gears. I'm gonna go back to my slides. So what do we have in here for you to learn about? We have the risk profile. You got to make sure you have access to a risk profile. This is reward and risk, and where do I gain? Where do I lose? You want to make sure that you are practicing. It's going to take you some time to learn it, the rest of your life to master it. I still learn subtle things about spreads that I'm like, ooh, okay. That's a great idea. Steven said, shorten the agenda, increase the weeks. I'm actually going to maintain the agenda and increase the weeks, right? I'm going to maintain it. So I'm going to get twice as much time on the second pass. We're going to stick to this the first time, and then we're going to shift it up the second time. Okay, let me get back to my slides. Excellent indeed. What am I doing? I'm selling one and buying one, right? I sell to initiate. The seller is the driver. This is a credit strategy. Long buy. That's my protection. The option is bought for risk management. So a bull put spread, what's our objective? Profit when the underlying asset rises or remains stable, right? It could go up a lot. It could go up a little. It could go up not at all. We make money no matter what. Examples, a bull put spread. We're going to sell a put and buy another one with a lower strike, just like we did. We have limited risk, limited reward, and I showed you the risk profile. Okay, number 2, a bear call spread. We're not bearish. Volatility is not high, but if it were, we would consider the possibility of a bear call spread. That's when we profit if the underlying asset falls or remains at or below a certain level. This is the bear call spread is to sell a call option at or slightly out of the money. So at or a little above it. What do we want it to do? We want it to remain below it. And then we buy an option higher than that to protect us, to contain our risk, to reduce our, remember, if we didn't buy the option above us, it would be a naked call. The difference, if you remember when we talked about selling naked puts last week, a bull put spread is very similar. All we're doing is buying a call to control the risk, to protect the downside, to reduce our margin requirement. Okay. Now, considerations for cred spreading. Number one, when should we do it? Higher implied volatility. The higher the volatility, the more premium you get, the more money you make. But increased premium can come with a risk. If it's off the charts high, something's happening. So be aware of that. Margin requirements. We want to make sure we understand how much margin we're going to tie up when we're doing these types of spreads. Because, and here's a funny thing. Bob asked a question earlier about credit or debit. And you'll hear people say, oh, I love credit spreads. I put money in my account on day one. Yeah, you do. You put money in your account on day one when you short a stock too, right? But is that your money? Like you can take it out and go buy yourself something nice? No. Your broker is going to hold that money, not just that money. They're going to take some of your money and they're going to hold that money too. In this case, think of margin. When you use margin for stocks, you're borrowing, it's a loan. When you use margin for spreads, it's an escrow account, right? It's an escrow. You collected premium. What are they going to do? They're going to hold it. They're also going to take any money that is required for you to possibly cover the trade, and they're going to hold that too. Both in your margin account. It's not your money, so don't let putting money in your account on day one be a reason for why you would choose debit spreads. That's not a reason. That's not valid. It's not your money. It's not your money until you're right. You still have to sell high and buy low, just like you would have to buy low and sell high if you did a debit spread. Bob says, I don't understand margin at all. I just know margin calls are bad. Margin calls are bad, without a doubt. And typically margin calls are going to come from over leveraging, right? Where you're over leveraged, you're over trading, you're borrowing too much. And now things have gone against you. And now the broker's like, hey, you better pony up. We don't have to worry about that here. Margin here is not bad. Margin here is just reflective of risk. How much risk do we have? How much are we tying up of our own capital to cover the trade? So we want to be aware of it, but it's not a bad thing. Risk assessment. We need to be able to use an option pricing model to assess and control risk and reward, right? We can't do it there's too many moving parts. If you don't going to have access to a pricing model, you're definitely not going to do spreads. You can do options. You can buy calls and puts without it. I would not suggest it. I would suggest getting an option pricing model because it's so useful. It's a tool and you need it. That's like saying, hey, you're going to build this house, but you can't use any saws. Wow. Could I do it? Yeah, probably. Would I want to? No, not at all. Right? I want, or how about this? Build the house with no power. No power. Everything works. But do I want to use a hand drill? Do I want to hammer nails or use an air gun? So, okay. Lastly, they require more monitoring and adjustment. There's more moving parts. They're more sophisticated. You got to watch it. You got to understand what's going on. You got to understand that risk profile on a dynamic basis, not just what is it when I start? What is it when the trade is ongoing? That's very, very important for us as well. I will tell you this, with alerts, if implied volatility is high and an alert comes, of course, the alert would be a bull put spread or a bull call spread, but not buying a call. Any alerts that I'm going to do market specific. That's what we have the ability is to tailor every option strategy we choose to the exact conditions we're in at the time. What are our conditions now? Bullish with low volatility. that a good time for bear call spreads? Obviously not. Is it a good time for bull put spreads? Probably not. The only other consideration would be time. How long are trades lasting right now? I don't know about yours. Mine are still 5 to 7 days. I don't get much for 5 to 7 days, right? I don't get much for that. So buying time still makes sense. Okay, let's summarize this. Oh, I didn't go too far over. Oh, Steven is stealing my segue. He said a good way to see how all this works is in paper trade. Yes. Paper trading is a great thing. It's a lot like golfing in Utah on Sundays. At least it used to be. But I used to tee off and then I'd tee off again. My kids would be with me. We'd just be hanging around. I'd let them drive the golf carts. I know, terrible, right? He's like 8 driving a golf cart. I'm like, yeah, it's fun. It'll be fine. But I wouldn't like, I'd play 2 balls the whole way because I could pay for 9 and I could really improve. Like, oh, I'm going to improve my swing. So if you live trade, buying a call, paper trade, selling a bull put spread, paper trade, a bull call spread. Watch how they work simultaneously. What's happening with the call? What's happening with the bull call? Amazing. Amazing. Buy the call and paper trade, both the bull put and the bull call at different strikes. Yes, please. Paper trade, paper trade, paper trade, paper trade. And if I didn't mention it, you should probably think about paper trading. And if you're going to, make sure you have an option pricing model. Okay, let's summarize this thing. Option spreads are a very powerful tool. When harnessed, proper research, risk management, a defined strategy with the right market perspective, with the right tools, you can unlock unlimited opportunities for profit for portfolio diversification. Knowledge is key. I'm opening Pandora's box, but clearly I'm not going to be able to like walk you through all the subtleties and nuances. I'm going to create some resources, reading lists, some sites, just a variety of option resources that will allow you to explore further the world of options, because it is just that. It's unlimited things for us to learn and understand. And so I will do my best to shepherd you and introduce you through as much as I possibly can, but I can only do so much in the time limitations that I have. So I want to make sure you have resources to explore further on your own. Owning your skills. Paper trading. Before you go live, practice. You can test different combinations with real-time dynamics, different strikes, different time expirations, everything like that. Option pricing models. You got to utilize, I didn't catch that. Black-Scholes. Black-Scholes is old. That's wrong. Binomial is old. That's wrong. Right now in Thinkorswim, we use Bjerkson Stensland. Show you how you would know that. But if I look here in this pricing model, I can go back to Black-Scholes if I want to go back to the late 80s. I can go back to Binomial if I want to go back to the late 90s, early 2000s. But if I want to be where I should be, I'm on Bjerkson Stensland. Okay. We need to be able to assess theoretical values and reward to risk so we can position size and we can look at everything that we need. And we need continuous learning, options and spreads, strategies, Greeks. We're going to do 4 weeks now. And then in a little bit, we're going to do 8 weeks. And that's not going to feel like enough. So continuous learning, continuous improvement, obviously is part of how we see life. Okay. Whew, that was a lot. This is helpful to me. So both my kids are soccer players. I played soccer growing up. My daughter retired, quote unquote, after high school, but the team she was on was a 2-time regional champion, which is the region consists of 14 Western states, and was 3rd in the country when she was a junior. They lost in the semis in Orlando. My son is she's a 3-time state champion. My son's a 3-time state champion in club, 1-time state champion in high school, and he now plays at Montana State University in Billings, where this year he was honorable all mention as a player and academic all conference as a student. I trained them a lot. Why am I telling you this? It's not to brag. I trained them a lot because I'd be like, I'm going to train them on this, and I'd have an idea. And then I'd go down, and I'd say down, our basement's unfinished, and I put turf down there, and we'd train in the basement. So I'd go down and I'd be like, let's do this. And as I'd actually start to deliver, I'd be like, oh, this drill sucks. This is terrible. Or I'd be like, oh, this drill is great, but I need to do this. That's where we are. We're guinea pigging this, you guys. I am going to adapt. I'm going to make it better. The second time around will be 3 times better than the first, because I'm going to be like, you know what? It was too slow here. We need to speed it up here. I need to talk more about this here. So I'm making notes while I'm giving this presentation so I can make sure that the next time we do it, it's better. Any feedback you have is appreciated. You can give it to me via email. You can give it to me via Discord. Any way you want to do it. But I recognize, I want to be done in 45. God, it took a lot today. I know what I need to do to speed it up next time. I need a little bit more time, obviously, and some other things. So I just want you guys to understand that we're committed. I'm committed to making this the best it can be. So whatever it needs to be to help you really wrap your mind around the options, great. Let's talk about it. Let's figure it out. But hopefully this gives you a taste of credit spreads. You can go build them. You can practice. I'm going to give you some articles on each strategy that will further your exploration. Some resources that'll be very helpful. So I've got to put those together. I realize how important those resources are going to be for you to self-study and do some additional work on your own. So great, we'll do that. But if you have any ideas, I'm open. Let me know. Other than that, any questions for today about credit spreads or just the world of spread trading? Do you feel a little bit like you just took a drink from a fire hose? It's a lot, right? It is. Here's my thought process though. People say, you know, or this would be my question. When you left this options foundations course, would you rather be underwhelmed or overwhelmed? And I have to think, if there's one thing I never want to be, it's underwhelming. I will never be an underwhelming person. I'll overwhelm the hell out of you, but I will not underwhelm you. And then my last question is this: is there such a thing as a state of whelmed? If I said, hey, how are you feeling? And you're like, you know what? I'm pretty whelmed. I'm not overwhelmed. I'm not underwhelmed. I'm just right there in the middle. I'm whelmed. Oh, you guys are amazing. You guys are awesome. Bob said it's going to take a while for this to stick. It is. It is going to take a little while, but I promise you, I will be here for you in the journey. We are in it together. We'll do this first pass, and then we'll do a second pass. Will we have access to review the material if we don't stay with the program? I don't know. I would say yes, if nothing else, for a period of time. But you better not drop from the program, Stephen. I'll tell you that right now. I know where you live. So yeah, how about that? I have your email. I'll send you a strongly worded email. All right, I gotta run. Let's talk tomorrow. Market seems to be kind of moving into buyer fatigue. I hope you're taking some profits and have locked some things in, tightened stops. Let's be ready to see what the pullback looks like. Market looks just as bullish, if not more so. So I'm not worried, but look how many things look great and now are too late. So what do we want? I want them to come back and give me another run. Let's take it. I want another bite at the apple. We said we may see a little bit of a consolidation, 2, 3, 4 days right here in the middle of December. And then boom, what do we want? Another window. So am I feeling a little greedy? Like I want to put my chips on the table? Hell yes. Hell yes. There you go. Steven said it great. It only has so much oxygen. You can only breathe in so much before you got to exhale. Let it out. Let's get ready for the next run. Thanks, everybody. Have a wonderful rest of your night. And as always, happy trading.